Here we have the adjusted trial balance for TSMC Company. Our task is to complete 2 steps. First, we need to record the 4 closing entries in the middle column. Second, we'll prepare the post-closing trial balance in the last 2 columns. Remember, the closing process always follows the same order: close revenues, close expenses, close the income summary into capital, and finally, close withdrawals. Take a moment to look at the accounts listed here. Which ones are temporary and will need to be closed? And which ones will carry forward into the next period? Once we work through these 4 entries, you'll see that only the permanent accounts, assets, liabilities, and the updated capital remain in the post-closing trial balance. Alright, let's walk through the closing entries one by one. The first step is to close revenues. We take marketing fees earned, $80,000, debit it to remove the balance, and credit the same amount to income summary. The second step is to close expenses. All 4 expense accounts, depreciation, salaries, rent, and miscellaneous, add up to $66,200. We debit income summary for this total, and credit each expense account to bring their balances down to 0. The third step is to close the income summary into capital. The difference between revenue and expenses is net income of $13,800. We debit income summary and credit TSMC capital for that amount. And finally, step 4 is to close withdrawals. We debit capital $15,400 and credit withdrawals, so the withdrawal account is cleared. After these 4 steps, every temporary account, revenue, expenses, and withdrawals is back to 0, leaving only balance sheet accounts plus the updated capital. That prepares us for the post-closing trial balance. Now that the 4 closing entries are complete, let's take a look at the post-closing trial balance. Notice what happens here. All of the temporary accounts, revenues, expenses, withdrawals, and income summary have been reduced to 0. You can see that marketing fees earned, all the expense accounts, withdrawals, and the income summary column no longer appear with balances. What remains are only the permanent accounts, assets, liabilities, and the updated capital. Cash is $9,200, equipment $42,000, and accumulated depreciation $17,500. Liabilities include salaries payable at $4,200 and unearned fees at $3,600. Finally, capital has been updated to $25,900 after accounting for net income and withdrawals. Both sides total $51,200, confirming that the ledger is in balance. This post-closing trial balance becomes the starting point for the next accounting period. Here, we show capital as a single account. This is a simplified version for teaching purposes, since TSMC is presented here more like a sole proprietorship. In reality, a corporation would use retained earnings instead of capital, and withdrawals would be recorded as dividends. We'll explore that corporate structure later in the course. For now, the key takeaway is that the closing process resets the temporary accounts and updates the owner's equity, preparing the books for a new period. That's it for Chapter 4-1. Great work. See you in the next session.